Here are 3 stocks that you should put on your watch list. These are what I'd probably call fallen angel stocks. They're high growth, great business, but their stock price has actually cratered since their recent highs. So I'll touch on a few stocks here, focusing primarily on the last one, and then I'll give you a bit of an idea of what I'm looking for in the market right now. And as of today, even though it is probably a Tuesday when I'm posting this, I'm going to try and post every Monday, Wednesday, and Friday from here on out. So turn on those notifications, mark it in your calendar, and let's do it. So the first fallen angel stock I want to talk about here today is actually Fiverr, ticker FVRR. This stock, as you can see up above to about the middle left of your screen, is down nearly over 50% from its recent highs in February. As of now, analysts still expect Fiverr to grow by 51% in 2021 in terms of their revenue estimate, and by 31% in 2022, which is still incredibly fast-paced growth. However, being seen as a stay-at-home stock has not helped them throughout this year, with them being down near about 12% since the beginning of 2021. Now, of course, much more goes into valuing a company than just a simple price to sales ratio, which is market cap divided by revenue for a given year. But we can see here that Fiverr is trading at roughly the same price to sales ratio as it was on August 3rd, 2020. So almost exactly a year ago from today. Now, a stock trading at 23 times sales, even when compared to competitors, say Fiverr's competitor trading at 25 times sales. I would not consider Fiverr cheap. I would just consider them both pretty expensive, especially historically speaking, where you see Fiverr trading more around the 5 to 6 times revenue range. But the purpose of this fallen angel stocks video is to find stocks that have great businesses, high growth rate, that were previously trading at nosebleed valuations. And it's, again, still expensive, but it's been cut in half from trading at 56 times revenue here to now 23 times revenue. And Wall Street can very easily continue to forget about this stock and kick it to the side until it reaches a more reasonable valuation, and that's when we as long-term investors would like to strike. And the next stock here is Lemonade, ticker LMND. Lemonade is an insurance company. They're bringing AI to disrupt one of the largest industries in the world, and they're doing it in a proprietary fashion. And since their peak in January, they've dropped over 62%, as you can see here, again, upper left side of your screen. And again, one of my favorite ratios to get a quick glimpse of a company's valuation is the price sales ratio. Now, the best way to use this ratio, again, market cap divided by year's revenue, is to compare it to other competitors or other companies in the same industry. However, as a kind of a general rule of thumb or guideline for initial due diligence like this, anything below 20 or 15 or even 10 for a high growth company is a bit more interesting for me. Now, Lemonade here is at 43. Again, even higher than Fiverr, still very, very high, but comparing it to January when it was at the high in the chart we just saw, a price of sales of 106, that has been cut in half, and this is another stock that I would consider a fallen angel. And there are stocks that trade at high price to sales ratios or high PE ratios for a very, very long time because they're just so unique or they're so unrivaled in their business model. Could Lemonade be one of them? Again, I just want to put it on your radar because it has fallen off from previous highs pretty hard. And this is also where I can encourage you as an investor to develop your own style and system, right? This is where you'd have to ask yourself, looking at the revenue estimates for next year and finishing off this year, expected to grow by 31% in 2021, and next year, a huge jump to 63% revenue growth, right? So does this 63% growth justify something like a 43 times sales? Personally, for me, it doesn't. If I'm going to be paying that much, 43 times sales, something that high, I'm more likely to go with an upstart, ticker UPST, which is in the fintech space, and also applying artificial intelligence in a very unique way. That's one stock that's gotten away from me. It's had a few amazing quarters. I recommend you guys all look into that one, but it's very much not a fallen angel. I think it's at all-time highs right now. And for our final stock here, we have StoneCo Ltd, ticker STNE. This stock, as you can see, we'll do it one last time here, is down about 47% from recent highs in February. A lot of growth stocks peaked in February, and then we hit that nasty correction in growth in late February, kind of early March. And we can see that StoneCo was just like the others that got wrapped up into that. And now, could this be an opportunity for us as long-term investors to kind of come in to these unfavorable stocks? stocks, right? We want to try and find stocks when they're maybe downtrending or cooling off or dropping hard from all-time highs like this, as long as the fundamentals are still solid. Because assuming the fundamentals are still solid, right? If, say the fundamentals, this is just an example. This isn't actually how it is because I still need to do due diligence for StoneCo. But say the fundamentals are this line right here, and the stock price is tracking. Boom, this is the Rona, and things happen, but the fundamentals, maybe they dip a little bit here, and then fundamentals catch up again, okay? And now the euphoria, the amazing 2020 stock market, it gets ahead of itself, and the stock price gets way ahead of fundamentals, way up here, and then it comes crashing back down to correct, to find itself, to ground itself, to come back to earth. And now the fundamentals are still strong, right? But the stock price has now disconnected to the downside, or offering more upside compared to where the fundamentals are at, because they continue to get better. So this is how I just visualize things mentally. I am not saying this is the case for StoneCo. I just want to make an example of why it's kind of counterintuitive. You almost want to get more excited about a stock if it is downtrending like this, even though it's in a longer term uptrend. If it is downtrending like this, that's when you want to get excited, right? That's where a lot of the opportunity is. It's much scarier and much harder to chase and buy into a stock that looks like this, where it's pretty much at all-time highs. But patience has rewarded those who have stayed on the sideline for StoneCo, and let's talk a bit about it. So the crazy thing about StoneCo is actually both Warren Buffett and Cathie Wood own shares or stake in this company. Now, not Warren Buffett directly, but Berkshire Hathaway, right? And I don't think it was actually Warren Buffett who made the trade. It was probably one of his portfolio managers, or lieutenants as they sometimes call it. But nonetheless, Berkshire Hathaway does own I believe a 3.4% stake in StoneCo. So right here, you can see they own, looks like 10.6 million shares of StoneCo in their holdings for Berkshire Hathaway. And this was updated March 31st, 2021. I think they initiated this position way back in 2018. So obviously they've done very well. And this is ARK Invest. This is Cathie Wood, ARKF. This is ARKF, their fintech holdings. Right here, you can see they've allocated 1.48% of ARKF to StoneCo. And again, I want to reemphasize that this 3.4% over here for Berkshire Hathaway is not their portfolio allocation. It's the percentage stake that they actually have in the company, StoneCo Ltd. So as you may have guessed, based on the ARKF holdings, StoneCo is a fintech company, and they're based in Brazil. You can kind of think of them as the Square of Brazil. So looking at their revenue estimates, there's something very funky going on here. My guess is maybe an acquisition that boosted their revenues that's now being compared to their year ago revenues. But I'd have to look into this next if I'm going to go further into due diligence for this stock on what the heck, why are they having almost 1,000% growth in the current quarter? But next year, I believe this is a more normal numbers. They're expected to grow by 53% in 2022, which is tremendous growth. And the crazy thing is that StoneCo is actually profitable. So they have a forward PE of 49, just under 50, and that's still pretty rich, but a forward PE of 50 for a company that's growing at 50% top line revenue, right? And I will note here that it looks like they missed on their last two reports, their last two quarterly reports. And personally, I want to look more long-term than quarterly reports. However, sometimes it does speak to management and how management can actually manage expectations if they continue to miss quarterly reports. So that's something I want to look into as well. And one great tip is to actually go into 10Ks and 10Qs from a year ago, 2 years ago, 3 years ago, see what did management want to execute on and what were their expectations and estimates, and then go back to present day or like 2 or 3 years later and see, did they actually hit those estimates? Were they able to execute? Did they over deliver, under deliver? And that's also how you can get a good sense of management if it's a completely new company. Now, of the three kind of fallen angels we've talked about today, StoneCo was the one that actually interested me the most right off the bat. This is one I'm probably going to look into more heavily as time goes on. So here's my kind of initial research so far. Their target customers are small to medium businesses, and their primary services include point of sale systems like a card reading machine, and they really want to grow with their customers. So, someone who's just starting their business, you want to sell anywhere. So card machine, you got QR code and enabling QR code capabilities, online sales, payment links, and e-commerce. Very basic. Then managing your money. You got the Stone card transfers as volume increases, payments and recharges, control and x-ray. You got analytics and all of that. Then growing safely. You have access to capital. They are able to facilitate loans, anticipation, loyalty, even insurance. StoneCo is able to make most of their money by charging fees for their services, including transaction, payment processing, subscriptions, equipment rentals, and repayment financing. And next, what I'm probably going to do is go to StoneCo Ltd Investor Relations. So all you got to do is really just look up StoneCo Ltd Investor Relations, and boom, it'll most likely be the first link. And you go through their recent conference calls, earnings reports. And what I love going through is their most recent 10K. That's probably the first thing I'll do, because in there, it's the most detailed document you'll usually get about a company. They do it once a year, and they have the business overview there that lays out the entire business model and all the risk factors as well, which is really important, because when you're investing, you also want to analyze the downside and the risks involved as much as you want to analyze the potential upside. And then, of course, you've also got press releases and presentations that you can look through. So those are my next steps. For the rest of this video, though, I just want to tell you guys that this Sunday, we have one of our mentors from investor community doing a case study on Palantir. So we are literally going from ground zero, from scratch, as if you know nothing about Palantir, all the way to building a fully fleshed out thesis with all the research, data points, questions, Excel sheets for a thesis for Palantir, going through 4 different sessions. So we already had our first session. The next 3 sessions, we're actually building out the thesis. Make sure you guys join by as soon as possible, because the next one's going to be this Sunday. So that'll be linked down below for investor community. And also, I'm part of a project called Hungry Bull. We just launched this app. It's an amazing stocks tracker app. You get also a daily newsletter that's very well written, and you can listen to conference calls on the app, which I think is such an underrated source of information these days when analyzing stocks, is actually listening to these conference calls, or at least getting transcripts. And the process I just showed you here of going to their investor relations page, and then you have to go and look for their most recent conference call, and then you have to go click here for their webcast, and yada, yada, yada. And then you have to oftentimes make an account like this. You don't have to do that if you just download Hungry Bull and listen to conference calls for whatever stock you'd like. You can also track crypto on there and a whole bunch of other things. But anyways, thank you guys so much for your time, posting Monday, Wednesday, Friday, and more if I'm able to. So let's get it. Thank you guys so much for watching. If you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.